me up if I didn't give them some credit. We have a very sophisticated IP department at HP that's constantly doing their own work. So at HP, if we want to bolster our patent portfolio, and it's just really purely for patents, our IP team will look at that as part of their portfolio. We do not, at least as far as I know to date, have really not looked at companies with that lens on it. And I think that's somewhat because HP has an incredibly robust patent portfolio today across stuff you guys would not even imagine. So I think HP feels really good about its portfolio across all the industries. So that's why I think we don't see as much of an emphasis. And like I say, if there are areas where we want to shore up, and actually it's really fascinating. I mean, our IP team is constantly in a sort of acquisition divestiture mode because there's certain patents that we just decide aren't important to us, and then you get into the whole issue of cross-licenses we do with other large companies that give us other protections. So I think HP and Cisco may be in the same position, but I think the breadth of our portfolio has put us in a very comfortable position. Now our IP guys may shoot me for saying that, but just by the size and history of HP, there's a lot there. So it hasn't become a dominant factor the way we look at things.
I'm happy to add to. I think the deals that Doug is referring to are these sort of mega value deals where IP was really at the center of the value of how a buyer thought about the value. And you could argue Google, Motorola would be in that category, and the Nortel patent sale out of bankruptcy, where the patent portfolio of Nortel, which was initially bid at sort of hundreds of millions of dollars, wound up selling for $4.5 billion in a bankruptcy auction, which was quite substantial if you think about the bankruptcy of Nortel. I think that phenomenon was a nice bubble. It came and it's gone. And if you happen to be at the right place at the right time with a lot of really good IP, particularly around mobile, you extracted enormous value and made a lot of money. But as it relates to just pure IP deals for value, I think that's over. And that's not to mean that you won't find bankers and other people running around the ecosystem trying to find the next one, but I don't think there's likely to be another big next one. I think that game has come and gone. Having said that, as it relates to IP in deals, particularly if you're a private company, while it doesn't actually capture value, it's probably the thorniest and stickiest part of the deal, particularly when you're negotiating with guys like these who know what they're doing, where you will probably spend at least a disproportionate amount of the risk in getting a deal done often hinges around the IP that you have in your company. The quality of it, the encumbrances of it, how good is it, how clean is it, how well you documented it, particularly if you have open source software. There are a lot of just minefields of problem, and Doug could probably speak to this far better than I can. But that, while that's not a driver of the value, in many cases it can be the driver of getting a deal done or not. And there are lots of deals that have fallen apart because of the IP.
Yeah, I mean, just to pick up on that, to the extent where one spends one's legal fees in a transaction is a measure of where the hard parts are. Generally, the IP diligence in a transaction is usually a third and can creep up to being a half of the total legal fees in a deal are spent on the IP lawyers probing the target company. So, there's something to think about there. Does anybody else want to comment on that, or should I keep? Yeah.
I was just going to add to that. I do think your perspective is right. I think there's this moment in time around mobility where you have 4 or 5 enormously wealthy companies who are saying, this is my play for the next decade or more, and I absolutely have to do whatever I can not to be encumbered by the person down the block. And you'll see it, and everybody in Silicon Valley is familiar with the intellectual ventures of the world coming and knocking on your door and asking you to join their consortium. But the types of sort of IP at the core is really extraordinary. And when I say IP, I literally mean IP as in patents. I mean, not even working code, just the patent rights to protect yourself.
I think what happened in the mobile space is a little bit like the Cold War. You had a bunch of superpowers, Apple, Google, and others, who all wanted nuclear weapons. And if you didn't have nuclear weapons, you never intended to actually fire the nuclear weapons. But if the other guy had some, you had to have some. And so basically everybody had to go out and build their arsenal. Now they're built. And so we don't need any more nuclear weapons. Well,
I think that's generally right. I think the only thing that I would add to that is that, back to Andy's comment, there are companies who have built that through sort of other means over time. And I think what you saw in the last go-around was that there was a game of catch-up for folks who just saw that the exposure was there and hadn't spent time building out those patents over decades, right? And had to very quickly mobilize to be able to find a way to gird themselves.
All right, so if one of the premises of in this evening, as advertised as most M&A fails, which I don't think anybody on this panel would agree with that blanket statement, but certainly plenty of deals don't achieve the results intended. From each of your perspectives, how do you advise, how do you ensure that a deal is successful? What are your sort of own watchwords about how to sort of ensure the ultimate success of a transaction? Maybe start down at Johnson.
Well, it's interesting you're starting with me because, everybody else here as an acquirer has a strategic rationale for doing a deal that they can judge the success of the deal by. They can say, it broadened my product portfolio, it added to my customer footprint, it took me into new areas. And one of the things I realized when I got into the business that I'm in now, and I came out of the corporate world, I was at Adobe, is that every deal I look at, there's no strategy that I apply it against. It's literally, I look at it and I decide, if I put 100 in, am I going to get 200 back? That's sort of an interesting frame because from my perspective, the success of the deal, whether it's financially measured, it may not be engineered, but it's certainly just purely financially measured. We don't buy a company in order to put it into another company.
So is the key for a private equity transaction, is it the proper motivation of the right management team? Is it about incentivizing the management team, and is that the key piece once you've found?
Our big effort whenever we invest in anything is, and there are many things that we go through in terms of trying to figure it out, and it's hard to boil it down into a sentence, but we focus a lot on the market. We're tech investors only, and so we look at the market and decide, is this a company in this particular market? And we don't define a market by saying mobility. That's just so broad as to be useless. So we look for the relevant market segment that it's in, and we say, can it be a leader in this market? And we begin from that premise, Doug. If we feel good about that, that's kind of step one. Step two is, do we have a team that can get us there? And for us, the structure of the deal largely means, how do we keep this team really, really interested in staying with us and doing it going forward? We really don't like it when people tell us they're just passing on to a new phase in their life and give them $100 million, but the business is great. I mean, I've heard that so many times. It's a great business, but I've just decided, I need a new challenge in my life. We really want the person who built that great business to stay with us in that great business until we get out, and then they can do what they want.
Andy, when you're approaching a deal, how do you judge its success, and then how do you ensure that you achieve it?
Yeah, I guess, there's different parameters depending on the size of the company. And I think, and Cisco probably sees this too, is we can look across a lot of deals, big and small, and there'll be different factors. I think you hit on some of them earlier. Smaller deals, sometimes team retention's important. This whole point about is the IP what we think we're getting. So you can sort of go through the pretty classic things you think about. I'm just trying to think of some of the, we don't have any deals that didn't work, so I'm struggling a bit with the question here. So I think that we did some work a few years ago to look at smaller deals. And I think one thing we found was some common traits about what made some deals better than others were the ability for the small deal to get traction inside the big mothership. So we pay a lot of attention on smaller deals to making sure it will get traction. I think there's the other thing I would say on smaller deals, maybe relevant to this crowd, is this point about IP, because coming into a company like HP, we're not buying a technology or a product, depending on where it is in the life cycle, just to deploy it in the United States and a couple of regions. We're in 170 countries worldwide. We're deploying something that we want everybody to be selling very quickly. And the biggest issue we can have is if we take a product, it's maybe not ready for prime time, a couple of the sales regions get disappointed, I'm sure you guys see this, and all of a sudden you're stalled. So sometimes it can be the product and the team is everything we thought it was, yet we stumble a bit because it may not have been ready for kind of worldwide distribution, and so being very mindful of that. I think on larger deals, larger deals tend to have more of what I call the escape velocity when they get into HP. There's a lot of momentum, a lot of good market momentum. So I would say the place we've struggled the most probably is more on the smaller deals around some of these issues about making sure it's deployed at the right time, making sure the sales force feels incented to sell it, that sort of thing. And then team retention gets brought up a lot, but if I think about the sort of look backs we've done, we've had a pretty good success retaining people. So I think it's really about how does this smaller company fit into the overall machine of HP.
Hilton Cisco is known as being particularly adept at integration and integrating companies it acquires. Help us understand a little bit about what the secret sauce is there.
Sure, the dark arts of the integration. It's in part it's the reps, right? I do think that over time, and we've struggled mightily early on in how you integrate businesses into a large machine like Cisco, and I think over time it built up a capability that was centralized and scaled, right, for the volume of deals that we were going to do. So there are professionals that sit in our organization whose daily job is to think about, plans for integration, execution of plans for integration, enrolling business units into the plan for integration, and getting them to do it, and across multiple functions. So, our cross-functional team, what we call the X team around integration, is something like 300 people inside the company. And we've got full-time staff within corporate development of 15 folks who are just integration managers. And so the way it works, typically in an acquisition of any scale or size, is that you've got, and that includes relatively small deals in our sort of parlance. You're gonna have a deal manager who is responsible for making the deal, right? So negotiating the transaction, working the internal processes, and getting the deal done from an execution perspective. They are teamed up relatively early in the process with an integration manager who basically mirrors them for a big chunk of the process, past term sheet as an example, that early. And begins to drive, in part, the diligence process to be able to discover what you need to discover to be able to inform your integration. And that's hugely helpful to us, not only because it helps us plan better, but actually helps you have a better negotiation, because you might find things that are hard to deal with that you want to be able to deal with up front, and it becomes leverage in the dialogue with the other side. So I think those are some of the sort of organizational and process things that we've put in place. I will echo Andy's comments about sort of size relative to ease or difficulty of integration. We have tended to find that large what we call platform type transactions tend to go relatively smoothly because they have critical mass. They tend to have go-to-market. They tend to have selling motions and a known sort of product and market traction that can sustain itself. The challenge oftentimes is the long-term integration of those businesses to be able to realize synergies, and that's a different chapter that we can get into as well. And what we found is that very small deals or tech and talent transactions actually work pretty well too, because you're effectively just snapping them into larger business units. It's the middle tier of deals where you've got 50, 60, 70 folks, a little bit of a sales organization, but it's mostly engineering, and they might be at a remote site. Those are very, very difficult for us to work through, and we spend a particularly large amount of time making sure that we're successful in driving those.
So we've got, I'm sure, a lot of people here who would love to sell their company. So we've got people who've bought a lot of companies and advised a lot of sellers. So let's sort of think about that angle a little bit. Maybe Ajay, you start. So where, if somebody's thinking about selling a company, they may not be ready for Goldman Sachs or for Deutsche Bank, but what's your advice to sort of how to think about sort of positioning your company for sale to a corporate buyer?
Well, first of all, I would say, I don't think that at least the folks that are in this room, I could be wrong here, but they are in this to, just kind of sell the company. I think what they're doing here is kind of, building the company, which is what they should do we just continue to build the company. It's like you build it, they'll come. Companies are bought, not sold. So the first and foremost advice would be to just continue to do the great job of building the products that you are. Continue to demonstrate that passion in the products, and continue to build the best possible products you can out there. Now, if it does happen that you're approached by an acquirer, then obviously you're put in a different bit of a mindset, and you have to start thinking about how do you position the company to sell the company. The first and foremost thing is always have an alternative. And the best alternative is to walk away. To walk away from whoever it is who approaches you. Have that conviction that if I walk away today, I'll have a much better value for this company tomorrow. And if you are indeed really that important to the buyer, they won't let you walk away. So always have an alternate plan, but continue to kind of build value in that company. Now, if you made up your mind that you want to sell, then either get Goldman or Deutsche Bank involved as early as you can. But I think what is important is also as you're building your company, obviously you are developing your group of partners. You're talking to either potential partners or other parties that can help you in different aspects of the company. And through those conversations, you always have some sort of a dialogue with other potential interested parties or acquirers. So it is always better to develop that dialogue as you go through through the company. So in the event that you're approached, you have other options. You are able to talk to some of the others and bring some of the others to the table to have a really strong hand in that negotiation. Then at the end of the day, it is clearly about negotiations and really understanding what kind of value is the buyer seeing in your company, and how to use that to your advantage.
Andy, do most deals at HP originate in the business unit with somebody coming to you and saying, can you help me look at this company or help me look at this space? Or do they start in corp dev and sort of from a corporate-wide strategy focus, and you say, what do you guys think about this idea? How do things sort of bubble up?
It's going to be a mix in a company as big as HP. And I would say sometimes the smaller deals tend to come from the business units. The larger deals may come out of some corporate strategy work that's done. But ultimately, for any deal we do, there has to be a business sponsor. I mean, there has to be a general manager who steps up and says, I'm going to deliver on these synergies, the business plan. So ultimately, even if it's something that originates through kind of a corporate strategy project, with our team, we ultimately have to find someone who's got conviction. So, I think we like to sort of position it as the business units kind of own these targets. And certainly the smaller ones, because to Ajay's point, I think the best advice is, we're not looking to buy companies that are looking to be sold. I mean, if companies are out doing their thing and they've got a great vision and they're working with customers well, I mean, they're going to come up on a radar screen if it's a fit. So it's a mix, but I think in general, some of the smaller companies may come from the business units because they're out there interacting with them, and the larger targets probably do come more from a corporate perspective.
Ryan, how do you? What sort of advice would you give to the target companies of the world? How do you sort of help them think about the M&A process? How to sort of approach corporates, approach private equity?
Okay. Well, before I do that, I do want to just kind of kill this like all M&A fails thing. So I don't think we have done that, so I'm just going to put that to bed right now. And I think you can sort of take some examples across the ecosystem of what we're all involved in. You can start over here with Skype. Skype was acquired at least twice, 3 times. And I'd argue at least in each case, wound up being reasonably successful. So you've got one asset and has traded now several times, I'd argue very successfully, and you can debate the merits of the price or this or the other thing, but there's one example. You can go to HP. I think, this is dangerous saying this up here, but I think 3Com's been fairly successful for HP, only a year and a half into it. Cisco, I'd argue, built its success, much of its success, in the mid-90s with a series of acquisitions in the enterprise switching market when they bought Calpana, which we were fortunate enough to be involved in selling to them, Grand Junction, which we sold to them, and Crescendo, was probably the most successful, arguably one of the most successful acquisitions ever. Yeah, it basically just clanked the router franchise with a whole switching portfolio. And if you go back to the mid-90s, there were 4 big networking companies: 3Com, Cisco, Bay, and Cabletron. And there very quickly became one. Largely on the back of strong execution, but also on the back of very brilliant M&A strategy. EMC bought VMware. We worked for another company to buy VMware, and our client offered $550 or $600 million, and we all thought that was nuts. And VMware now is a, I don't know, $40 billion market cap company, all on the back of M&A. And so you can go through lots and lots of examples in the technology world of phenomenally successful M&A. So it is not true that most deals fail.
Sure. Yeah. The other thing I would just say is great general managers and great CEOs look at M&A as one more tool to build their business. They develop great product roadmaps, they deliver those products, they have a great sales team in front of it, but they're constantly scanning the environment to say, is there some asset that I can buy appropriately that will make that platform even more interesting? So I think when I run into general managers or CEOs who are orthodox about saying, I never do this or I only do that, it's a red flag for me, because it's the purpose of a business is to build it and to do amazing things and to have an impact. And so this is one tool, and done appropriately, it's absolutely an appropriate tool, 100% valid. So just.
And I think your question, Doug, I'm not sure I remember the question now, but I think it was.
Your answer was better than my question.
I think well, that's usually what a banker does, is answer whatever you want to talk about, not what the question was. And that way you always look smart because you knew what you were going to say. But I think if the question was, what advice do we have for people who are thinking about selling their business, I would say 2 things, 2 general pieces of advice. One is, and it's sort of already been touched on, but I can smell a seller a mile away. And if I can sell somebody who wants to smell their business a mile away, these guys can. And that either means they have all the leverage, and so now you just lost a lot of money in terms of price, or they don't want to buy you, because most people want to sell really shouldn't be bought. And so that whole concept really is important, and no matter how much you say to people like us that we're really not looking to sell our business, everything you do, the body language, the way, it's just very obvious. And so if you really are a seller, don't pretend that you're not. Just say, I really am a seller, and then we'll just, there's a different way to do that. But don't try to pretend that you're not and you're being courted because you're pretending. So that's number one. And number 2, and they're very related, is particularly as it relates to the Silicon Valley area, this is an extremely small community. And no matter who you are, somebody at either the company that's going to buy you or the company that's going to look at you probably knows who you are, or knows somebody who knows you, or knows somebody else who knows somebody who knows somebody who knows you, or knows some of your investors. It's just such a tangled web of relationships. And the reason that that's really important is that many people are repeat entrepreneurs. If somebody doesn't already know you, they'll know you the next time around. And so it's a very, very small world. And the way you carry yourself in dealing with a buyer or buyers, if the deal falls apart, just the way you carry yourself and the ethics involved in doing what you do is just paramount. And there will be a time in every deal I've ever worked on, there is always a critical issue. There's always something that stands in the way of getting the deal done. It could be the IP, it could be some contract that you have, it could be that you need permission from somebody to, on a change of control, you have to get permission to do something. It could be that they need a reference from a customer. There's always something where some issue has to get solved, usually among the principals. But we can give advice around how to think about it and what your options are. At the end of the day, the principals, these guys, have to sit down with you and basically figure out what are we going to do about this problem and how are we going to solve this problem and get the deal done. And how you carry yourself up to that point and then through that point is critical. And that is probably the most important piece of advice I can give. And then the last one, which is sort of then back on the integration question, I would say that the thing that I've observed the most in terms of why deals do fail, and there are a lot that do fail, is that either the buyer or on the seller side, just the team didn't stay together after the deal. And Cisco's done a terrific job of this over many, many, many years of keeping all of the senior people in the things they buy, motivated, incented, and aligned, and then very productive. And if you look at a lot of the deals that are sort of colossal failures, in most cases, either the CEO, technical people, whomever the right sort of leadership group of the target are, leave quickly after the deal. And that's, I think, the simplest recipe for failure in a deal. And so when you're on the buy side, we always tell our clients on the buy side, figure out how you're going to keep the team, the core team, identify who they are, that's the first part, and that's not so easy always. figure out who those key people are, the thought leaders, and then who beneath them sort of follow those people, and figure out how to keep them incented and motivated, make sure you have alignment on the deal that you're doing, and then 2, keep them locked in. And when you're on the sell side, if you're taking stock and you then care about what the combination looks like, in some cases you don't care. You get cash, you go away, you do your next one, and then sort of buyer beware. But if you care about the outcome, making sure that the team around you is going to stick around. If you're not going to stick around, that the key team is going to stay is critical.
I think we should open it up for questions. I'm sure there are a lot of questions for this panel, so we'll start right here.
The microphones actually come to you, so wait till the mic comes to you, then you can identify yourself and ask the question. Thank you.
Is it me or? Okay. Yeah, I did IP due diligence in 3-4 transactions in M&A, and my question is for you, Doug. I know we discussed most of the M&A fails.
I'm the moderator. I don't answer questions. I just answer.
You diverted.
Yeah, I mean, I think we got a lot about integration, like why M&A and integration is so important. But a lot of companies, they have strategies against M&A, and it makes it almost impossible, or sometimes it does not make sense. Like sometimes they have shareholder rights, or they have poison pilling strategies. So how do you typically deal with those issues? I know we have hostile takeover strategies, and then we have
Yeah, I want to make sure I understand the question because there's a few different things you touched on. You touched on sort of an IP piece, but also sort of takeover defense in terms of...
Yeah. I mean, we discussed a lot about integration in M&A transactions, but sometimes there are problems in the stock agreements or shareholder rights. So how do you typically go ahead?
So
with those?
if I understand the question, I mean, there are, for a public company, there's the ability to do a hostile takeover because the shares are publicly traded. And so if the question is sort of how do you deal with
the private companies.
So in a private company context, you really generally can't do a hostile takeover because the people sitting around the board table generally control the majority of the stock. And so if they don't want to sell, they don't have to sell. And so you can't force a private company to sell to you, generally.
So then that means that the merger would fail right away?
You just can't do it. I mean, it's I can't make you sell your house to me. You own your house, I can't do a hostile takeover of your house.
Okay.
So it's just the control is inside the company. In a public company, because the shares are publicly traded, there's various ways, which we probably shouldn't get into in detail here, but basically there's a way to acquire the company over the objections of the board and the management of the company. It's a risky thing to do and usually more expensive to do it than in a friendly deal. But that's sort of a subject unto itself. We'll go here.
Hi, I'm Ritu Malhotra. I have 2 questions. So the first question is, we often look at the statistics and say, well, this deal failed. How much do you evaluate the deal versus the standalone scenario, for example, because the goal may not have been achieved, but it's relative to other scenarios and the market environment is constantly changing. So that's the first question. And the second question was really about the group buying sites. So for example, Groupon was not bought by Google and they seem to have some internal management changes, perceiving that as a failure. But then Groupon has lost 1/3 of its value. Nobody else has made a bid for it. Living Social, nobody has made a bid for it. So how do you see that environment, or how do you see that subsector developing? What are the exit opportunities? Are they in public markets? Are they in M&A markets? Or do you see it as a function within, say, Google offers? That's
Who wants to? There's a few different pieces of that puzzle. So yeah.
I'll take the first
okay.
chunk of it, and then I'll
Okay.
give the second chunk to somebody else who can actually answer it with intelligence. On the first one, you know, I do think it's really critical to figure out what you're measuring at the outset, right? So, you know, I think to Andy's comments earlier, different deals that you do may have different objectives, and by definition, you know, you need to figure out what you want to measure against and what that's going to be over time. And typically you'll have a playbook to be able to do that. And for us, you know, I think measuring against what you thought the plan was going to be at the very beginning is a really simple guiding principle, right? So, you know, if it's a public company that's got a trajectory, okay, for the most part, your commit within the business needs to reflect either that or presumably some premium to that, and if it's not that, then you need to reconcile that with yourself, with, from a corporate perspective, why that makes sense, because there are other synergies associated with it. But the most important thing is to understand what that baseline is up front, and that includes, targets relative to retention. There may be deals where it doesn't make a whole lot of sense for you to retain 100% of the folks in the team, but there's some critical percentage that you need to be able to maintain, and then you track that. And if you have a challenge, you have mechanisms by which to go and course correct and deal with it in the look back. It's not just that you look at it and say, oh, we have a problem. That you actually have a mechanism to deal with it, because oftentimes corporate transactions end up in a business where remediation is more about the corporation or finance or different operations coming in and being able to help a business right itself, and perhaps bringing different leadership in place to be able to go and do that. So I think that's really important, is just establishing what it is you're trying to measure. And for us, it's a discipline that we've learned over time, and it's a discipline that is tough, because what it means is that there's some percentage of the deals that you've done where that's not going to look great, right? And in any portfolio approach, especially when there's volume involved in M&A for a company like Cisco, there's going to be some percentage of the deals that just are not going to make it over the finish line in terms of success. But that's okay, and I think understanding that that's okay, and that if you're not failing a little bit, then you're probably not taking enough risk, is, I think, a principle that we've tried to establish. And again, figuring out what you're measuring, how you're going to measure it, and how you're going to take action once you figured out there's a problem, or accelerate things if they're going well, is really crucial.
Yeah, John Chambers actually said, I remember the video was 15 years ago, he just said, if every deal is successful, we're not doing enough deals. And very...
Maybe we respond to the second part.
Oh yeah, I'm sorry, right, yes.
About the social sites.
Yeah.
I think, for the record, if I had been an owner, I would have sold to Google when they made that offer. But I think there's one thing that's a little misunderstood, because I looked at this space to try and sort of understand what was going on. And one of the things that I was talking to somebody earlier about is, for small businesses, these are upfront cash flow machines. And people don't always appreciate the fact that small businesses doing business with Groupon get the money up front before the customer shows up. So there's a positive working capital cycle. It's not terribly good for Groupon in the sense that they're acquiring customers, but I was sort of trying to figure out why so many people were interested in playing this game, and I think I sort of figured out why they'll play the game, because if you're the little restaurant, you actually get the money before the customer shows up. So there might be enough of an interesting positive working capital cycle there for people to keep playing the game for a long time with Groupon, if Groupon can stay together that long and cover their cash needs. I don't know, you guys probably looked at it carefully.
We're underwriting the IPO, so we're not going to comment.
Yes. My name is Sri, and I'm in the corporate development for Blackhawk Network. My question is regarding earnouts. So, of the technology M&A transactions, on an average, how much percentage of transactions have earnout? And for those transactions that have earnout, how much it is as a percentage of the value of the deal?
I mean, there's no one answer. So the question is sort of earnouts and how big a piece of the deal they are, and that depends. I mean, basically, what an earnout is used for, at its most fundamental, is to bridge a valuation gap that otherwise is unbridgeable. But I'd be interested, since we're on the topic, first of all, one thing which is often said about earnouts is always paid, rarely earned, usually litigated. So what an earnout does, for one thing, is it introduces a lot of complexity and a lot of potential for dispute into a deal. And so they have to be very carefully crafted, tracked. There's a lot of issues that sort of come into play when you introduce a big part of the consideration being contingent. But I'd be interested in hearing, maybe first from the corporates, how often you employ earnouts in your deals, what you think of them.
I'm trying to think back, so I've been at HP almost 6 years. maybe a couple times we've used them. We're not big fans of them. I think, to Doug's point, it's more the complexity. We've sometimes got to negotiations over them, but they just fall apart over the complexity of implementing them. Because I think our view is, to potentially avoid some of the downstream things, we want it pretty simple, pretty straightforward, pretty black and white. And then when you get to sort of that level, it creates some uncomfort. Sometimes I've found we've used them a couple times, almost as a we've had a valuation gap and we sort of reached an impasse. Rather than walk away, the earn-out has sort of served as this useful tool to kind of keep bantering about to try to reach closure, almost as it's a Trojan horse to keep the discussions going. But I personally am not a big fan of them because of a lot of the issues you mentioned, and they're just too hard to get done. I mean, it's if there's a good deal to be had, we'll reach agreement on valuation, and we won't have to rely on something to bridge the gap. I mean, it's sort of a simple philosophy we have.
There's not a lot to add to that. I think it's pretty much the view that we've got, which this is a very difficult sort of mechanism to utilize and utilize well without challenges down the road that you just have to renegotiate. I mean, the only thing I would add is that there is an element of dependency that gets introduced whenever you pull something in, and did you hit the target, did you not, based upon things that you needed the corporation to do for you, were you funded properly? So all the things that go along with so the complexity there make it hard. I would say that the one exception, and again, it's still rare even in the context of Cisco, is the idea of a spin-in, right? So if you can sort of think about that risk externally and look at milestones with an option to be able to pull something in, and you eliminate kind of the dependency question, those are structures that we will consider from time to time in extraordinary cases, but we're not big fans of earn-outs or spin-ins, frankly.
Okay, so this is a good example of a different structure. We don't integrate our companies into anything. They exist standalone. So we don't have the issues of the post-deal integration strategy screwing up the potential momentum of the business and resulting in litigation and people worrying about their earnouts. So we use them all the time. And we do it multiple ways. Mostly what we do is we agree to pay a fixed price for a business, and at the end of 2 years we'll either own more or less of that business. So the earnout isn't necessarily expressed in terms of more cash, but it's usually expressed in terms of our percentage ownership of the business. And the negotiation with the seller, can go multiple ways, but what at least I have found is that sometimes the seller likes to get a big number up front, and so we own a little bit less of the business, but then if they miss their numbers, the business gets cheaper for us, and we end up owning a bit more. And I usually find that that's easier than going back to them and saying, I want more of the business, or vice versa. So it's just kind of there you have the real distinctions and the interesting differences, which is no one can say, look, all of a sudden I had to report to somebody else and I couldn't get my budgets passed in time, and so give me my earnout.
Did you have a question? Yeah.
Thanks, Doug. I want to ask you a question since you're moderator, but compliments, great panel. So my question is to Andy. Having been in M&A and for the last 10 years as a venture capitalist, my experience actually was slightly different from yours. When we are looking at a small company, either acquiring or being a small company being acquired, we find that the small company has entrepreneurial spirit, which absolutely clashes with large company hierarchy. And so I was intrigued when you said that you have the barbell, with the small company works well and the large company, M&A works well, but the middle doesn't. And then the second thing is, in the large company, we find that there's a lot more host graft rejection, primarily because the cultures don't necessarily match. So in the first case, it's definitely an entrepreneurial spirit versus large. So I was curious why you had the success, but we didn't see it from that point of view.
So maybe I misspoke. I don't. No, not on the point that no, on the first point. I think I'm not sure I made a distinction of something in the middle. I think I was just saying if I look at sort of two kinds of
You said
deals.
50 to 70 group is the hardest, if I recall, I could be wrong.
Yeah, I think that's what I thought he says.
Is that okay?
No, I think the point I was trying to make is if I put the deals into two buckets, large deals and small deals. The smaller deals are the ones that tend to be a little tougher. I'm not sure I would categorize anything in the middle, so I'm sorry about that. And then your other question was, you're saying that the larger companies you see more of a culture clash.
Yeah, like a horse crop, because large companies over time have created a culture, and it's not that easy to have those two cultures come together. I mean, a small company, you have to deal with less people, incentivize them well, keep the entrepreneurial spirit, you keep them. But do you see what I'm saying?
Yeah, I'm just trying to think of some examples. I mean, certainly.
Daimler, Chrysler.
Yes, yeah, that's a big company.
Right. But it's fascinating, I just thought. Then another quick question, I saw Brian, and I think John and Ajay, I think we were looking at a financial chart, talking about the factors towards, that is driving an M&A. And one of the things that I noticed, at least from a venture capitalist perspective, since there are no public markets, we find that is a major factor, but I didn't see you comment on that because we have no option for public markets, so we all have to sell. And so M&A is the only option in many ways. So I was curious that you didn't think that was compounding the effect.
I'm happy to start with that. By the way, I'm not sure on your question, Andy, on the big company. If you're talking about big company merging with big company, a lot of the times why those are so difficult is because oftentimes it's not clear who acquired who and who's in charge.
It's like a Sun Oracle dynamics, right? Yeah.
You're stapling two things together, and you do have some of that. I've observed some of that cultural issue in sort of mergers. But on your question, on the public markets are not really closed. I just done an IPO in the last week or two here, so they're not closed. They're not likely to be closed, and as tough as they are right now, the IPO market will get better. I mean, if you look at the IPO market over the last 10 years, every 6 to 9 months there's a cycle. And it gets good, it gets bad. Sometimes the cycle's longer.
It must be industry then.
What's that?
It must be industry specific because...
I'm talking about technology.
No, I understand. So then I think, I'm just looking at from the medical device, biotech, IT, mobile health. There, I think, is definitely closed.
I don't think so. I mean, I think it's tougher. I mean, we did a healthcare IPO. We did a healthcare IPO Tuesday or Wednesday. And so I think the markets are tough. There's no question about it. Ironically, I actually think that has eased the ability to do deals, because if you went back to the summer, early summer, before the market started to fall apart in July, the view in the IPO markets were frothy, very frothy.
Right.
We were doing a lot of internet IPOs going public and trading at very robust values right out of the gate. I think most venture people sort of took that and said, okay, my company's growing, and I just extrapolate out, way out there, and had views of value that were just very, very, very high, relative to what corporate buyers might be willing to pay over a normal period of time. And most buyers don't chase the tape. They think about fundamental value, they look at long-term models, and they have a view as to what it's worth. When the markets come down, which they have done now in the last 2 months, I actually think it's easier to get a deal done now, not because there's no alternative, but because the view on value, particularly for the sellers, has become a little bit more rational. We've just done 2 sale transactions for companies that would have gone public probably in the first quarter of next year. A company called LightPoint that we sold to Teradyne, and a company called Q1 Labs that we sold to IBM, where in both cases, those were IPOs that would have happened next year, and the valuation negotiations around that had nothing to do with the IPO market being closed. And in both cases, both companies were approached a long time ago at much lower prices, and in some ways they're willing to just hold out and say no and say I'm going public, and actually argue around the valuation of the IPO whenever it was going to happen was the biggest driver in the price, and the markets coming down really didn't impair that at all.
Yeah, that's exactly right. I mean, as Ryan said, we've done an IPO just last week for a technology company. To his point, there are many private companies that are actually thinking about the IPO market as an alternative. Remember the alternative I talked about? As a private company, you need to have an alternative, and the IPO is an alternative, right? Earlier this year, we also sold a company, Force 10 Networks, which was on file with an S1, and they got sold to Dell. So I think the IPO markets also, the other thing is that there are windows, they open and shut, and there is almost always, if you're patient with your companies, there will be an IPO option, assuming that the company is ready to go public, has the scale, visibility, customers, and everything. So I don't think you should consider the slowdown in the IPO market as you don't have that option. It's just about the right time, being patient, and really having that alternative for private companies.
Great. Why don't we take just a couple of more questions and then we'll stop. It is it's almost 8:40.
Hi, so my question is about secondary markets. I wanted to know, recently there has been a lot of growth in secondary markets, and it's been leading the valuation for companies like Facebook and others. How does that impact the M&A market for you guys?
I'll try to take that. So the secondary market, first of all, it's a very small market, and the so-called secondary market is for companies like obviously like Facebooks and Zyngas and Twitter and Living Social and Groupons of the world. It's not a very liquid market, and that market is again specifically designed for some of the early investors and more so employees of the company to get some liquidity out of the stock in that private company. So I don't think there is a direct correlation between having a secondary market which is again a very small market. It's not, I mean, you don't get good visibility into that market. You just read about it in the papers, and there are some trades that are done by some high net worth individuals in buying or selling some stock at a certain valuation. So what that does though is that it identifies, or at least it tells to the whole world this is what the company is worth today. Facebook last I read was worth $77 billion versus somebody buying it at $90 billion. But again, there's no, at least I haven't seen it as a direct correlation between that secondary market versus M&A. Now there might be some companies, private companies, who, like a Facebook or like a Groupon, as was mentioned. There are a lot of companies in that space that have come up that might use that as a benchmark for their own view about what their business should be or could be worth, and that kind of creates some sort of an issue. But again, I don't think I would rely on the secondary market as as sort of a barometer for M&A in that particular sector.
Yeah, it's worth pointing out that there's two kinds of secondary markets. There's the type that you're probably referring to, which is more of a private exchange. But then, of course, there are secondary transactions that are negotiated all the time. Private equity firms like mine frequently buy shares from founders of companies. We find increasingly that we don't like to do all secondary deals. I mean, we like to put money into businesses that have a strategic purpose for it, so that we like doing deals with primary capital. But almost every one of our deals has a secondary component if they're of a certain size. And so the entrepreneurs, in some cases the earlier investors, are allowed to get some liquidity, even as we try and create an environment where there's enough on the hook for them that they stay focused. So there's kind of two secondary markets that you should be thinking about.
Okay, last question.
Me?
Right there.
Hi, my name is Sanilan. I have a question about what are some of the best practices that you can recommend that in terms of doing the valuation of a company, that is so that there is a good meeting of minds from the seller perspective as well as the buyer perspective.
If we gave you all the secrets, you wouldn't need us. I mean, the answer is, my view on that is it's easiest when you actually have things to look at. You have a real business that's growing, that's got credible growth and strong position in its markets, and in some cases hopefully either profits or profits on the near-term horizon, upon which you can use all of the financial math and analytics that we use when we're sort of making a valuation argument. And these guys, I noticed, that do kind of the same thing in reverse. And we usually use the aggressive assumptions, they use the conservative assumptions, and you get two different numbers, and then you negotiate. And that's, I think, most often how I'd probably say almost every M&A deal happens. Yeah. Ours is the real estate.
I think that's exactly right. It's just about negotiation. It's what is the lowest seller is willing to take, and what is the highest the buyer is willing to pay. I mean, and then try to find a middle ground. And It doesn't happen too many times, but if there is a valuation gap, you try to bridge it with an earnout.
I think we're through our time, so yeah.
Perspective, it is, I don't know if you folks realize that, but we have been going in this for more than an hour and a half. Right? Time flies when you're having fun.
So you said, the panel had combined done $1 trillion worth of M&A, so that would fund the U.S. government for an hour and a half. So there you go.
And then, obviously it was a fantastic, very insightful panel, and hope everybody understood that the art and science of successful M&A is, starts with having the right buyers, right? These, Cisco, HP, Silver Lake, having the right investment bankers, from Deutsche Bank and Goldman Sachs, and having the right lawyer to moderate.
Especially the lawyer.
So I just want to, on behalf of I and on behalf of the Group Company Forum, thank each one of you for the generosity of your time, right? and obviously the experience that you have shared with us today. It's extremely valuable. Please give them a big round. Thank you to Doug for doing the difficult job of keeping